Hey everybody, welcome back to another edition of Money Matters with Mike Hill. Yes, I am solo today wearing my Aggie maroon vest. Yes, I am an Aggie, so the Texas fans, if you want to turn this off right now, I understand completely, but we're not in November yet. Let's see, and hopefully that I'm still wearing this in November because we're still winning. Tends to be our problem in November for those of you that aren't football fans. I'm here in Union 28, the Haunted Castle, because this is October and we wanted a little bit of flair. No, we don't need to clean up, but we're doing our best. So wanted to talk about a subject today with me because I get this. In every October, we've had some of the biggest sell-offs, 1987, 1929. We've had some big sell-offs in the month of October. Not that I'm expecting that, but it's another way of saying sell-off is volatility. Doesn't that sound a little bit better? Volatility as opposed to, oh my gosh, I've lost half my 401k. So we're going to talk about volatility. What is volatility? Well, first of all, it's big swings. It doesn't always mean down. It doesn't always mean up. It means one day the market's up 500. The next day it's maybe down 500. That's volatile. That's, like your uncle at Christmas that had one too many to drink. It's a little volatile, okay? A good thing to measure, if you want to look at it, is VIX, V-I-X. That's a symbol that measures volatility. And typically, the higher volatility goes, the bigger the sell-offs there are, because that means people are unsure, they're buying on lows, or they're not buying at all. It's kind of related. The less volatility, that means there's less fear in the market. That means there's more people that are tending to not sell, not necessarily buy, but they're just holding. But the less volatility, the calmer the stock market. So that's what we've been experiencing recently. April, when we had all the tariff talks and all the things, and oh yeah, well I'm going to tariff you 100%. Oh yeah, 150. All that back then tended to make the market very volatile, and therefore we had about a 12, 13% sell-off just in the month of April of 2025. So acknowledge when you're going through one of these. And by the way, sorry, I always forget to do this. Please like or share. We are getting new subscriptions every day. We're very proud of that. We're proud of this channel. We want to get this education out to the general public. We're right here in Midlothian, Texas. Come by, say hi, have a cup of coffee with us. Tell us what you would do different on this podcast. I've gotten a couple of those, and they're not just from my mother, but that's okay. I'm all about constructive criticism or just criticism. I don't care anymore. So, I definitely I hope you're enjoying these. I hope you're welcoming the information. I want it to be more than what you could just get on Google. So acknowledge the emotional roller coaster, fear, uncertainty. Typically, they say the pain of losing money in the market is 3 times more than the rush, for lack of a better word, that you feel when you make money in the market. So that's human nature. When you go from 100,000 in your account to 120, yay, we're all well and good. But it's still at 120, and let's say it goes down to 110. You still have 10,000 more than where you started. But most people complain about the 10,000 that they lost rather than the $10,000 that they're up for the year. It's just pain, for lack of a better word. But if you haven't sold, and I know it sounds like a cliche, but it's true. If you haven't sold, you haven't lost anything. You haven't made anything, you haven't lost anything until you sell. Market fluctuations are part of the process. They rise and fall, but the long-term trend, and Warren Buffett is a big practitioner on this, the long-term trend of the market is if you look at the left side versus the right side, if you look long enough, the right side is higher than the left. Now, sometimes you get just 2 months, and the right side is lower than the left side, but over time, the right side's higher than the left. Now, this is a little bit of a misleader because when you're younger and you're 35 and you're 40, hey, you got all this time for the right side to go up. When you're 65 and it goes down, I don't have 5 years while I'm taking money out, by the way, to wait for this right side to go up. I've dealt with this so many times because the majority of my clients are 50 and older, and I'll get the son who's a financial degree, or I want them to be involved. But hey, Mike, don't ever sell. I never sell and I'm doing well. You're also not taking money out. You're also still working. You also have a 401k. It is a completely different mindset investing when you're retired or close to retired than when you're still working. I can't stress that enough. That sounds easy, but it is hard. People for 30, 40 years will have a 401k building wealth and go, well, I built all this wealth investing this way. Okay. But now you're taking that money out. It's like the squirrel that has been putting nuts in a tree for 30 years. And now you go, hey, you got to take some of those nuts out. The squirrel's first reaction is, what? All I've been doing is, I don't know anything else. I don't want to touch those. That's what it's for. But you can't risk all those nuts if you got to make those last for the next 30 years of retirement. So that's where volatility needs to be hedged. Volatility needs to be planned for. Volatility needs to be expected in retirement. And if you do not plan for it in your accounts, then you are absolutely, in my opinion, not investing in the best way to make income last a lifetime. So focus on your personal financial plan is another way we can get away from volatility. Diversified portfolios versus having a portfolio that's 50% in gold. Love gold. Gold's at an all-time high. Would I have 50% of my 401k in it? No, because it can also go down 10% in one day. It is a metal. It is not something that I could just say, hey, send me all my gold and go to the gas station and buy a gallon of gas with 1 ounce of gold that's worth $3,800. Not real practical. I like it, but it should be a portion. And gold typically, like real estate, does well with inflation, or even better sometimes when the stock market sells off. That's why you diversify as well. Don't let headlines change. Don't let it change your goals. I've been doing this 28 years. I've gone through the 2001 crash. I went through the 2008 crash. I went through the 2020 sell-off for COVID. We're higher than we were in every single one of those within 3 years. Within 2 years of two of them, we were higher just 2 to 3 years later. Can I wait that long? Maybe not. Now, I will tell you why I think the market is higher now, and I won't get into particulars, over the last decade and a half, is because if you go look at a chart from 2001 to 2011, it's called the lost decade. You had the 2001 9/11 crash. You had the 2008 real estate crash. Both of them sold off. By the time you got to 2011, 10 years, you made 1%. And I need my facts checked on this, but about 1% is all you would have made over that length of time. So now we get out of 2011, start cutting rates, do all the things, have surplus, have Q1, Q2, QE3, and now the market's at 3 times what it was in 2011. I think that lost decade is what set us up for this. So I'm not saying you can't go 10 years without losing money. We've just done it in most of our lifetimes. So you have to hedge for that and diversify during those times. Real estate did well from 2001 to 2011. So fear-based selling. A strategy that I try to tell people is, and it's nothing new, but we've kind of changed it the way we do investments for our clients. It's called bucket investing. You set aside money here for 3 years, 4 years to live on. It is fixed. It doesn't have a lot of stock exposure because you don't want to sell off when you have these swings. Hey, Mr. Smith, I know you really need that $5,000 a month, but the market's down 10%. I really don't want to sell out of your stocks right now to send you a check. That account you set up to where it won't go through those swings. It won't have a lot of, you're not going to brag that it's up 20%. Then maybe you have a middle account that's more growth. It's 5 to 10 years oriented. You could go through some of these. And then you have your fun account for vacations, for kids' trips, for property taxes. You should have, in my opinion, of course, bucket investing. You should have money that is set up for certain different parts of your life. That way, when the market sells off, you're not sitting here screaming that this middle account's down because you know the bills are paid over the next 3 to 4 years. Dollar cost averaging. If you're young, what's a good strategy? You want to sell off every now and then. 401ks are notorious for this. You're putting money in every single paycheck. By doing that, you're doing what they call dollar cost averaging. You can look it up, or as we learned in the last one, you could ask ChatGPT how to do it. But that's basically where you're putting money in every month, no matter where the market is. So sometimes you're going to have highs, sometimes you're going to have lows. By the end of it, you'll have a higher value because you were buying some stocks sometimes down here, even when you didn't know when you were buying, when they were low. You bought sometimes when they were high. Keep an emergency fund. I can't stress this enough. There's so many planners. Dave Ramsey's big on this. You need to have 3 to 6 months of emergency funds. I can't tell you how many people call me and say, Mike, I know I hate to do this. I got to dip into my IRA. Well, now you're going to take out and you're going to have to pay 10% in taxes. And if you get some 59.5, you're going to have to pay, or 10, 12, 15% in tax. And then you're going to have to pay a 10% penalty. Have that emergency fund so when the hot water heater goes out, when the air conditioner goes out, and if you don't have an emergency fund, in my opinion, you should be putting into that emergency fund and putting the minimum in a 401k that's matching until that emergency fund gets up to 3 or 6 months. Regular portfolio review. Are you talking to your advisor? Are you meeting with him at least every 6 months? You don't have to meet him face to face every 6 months, but man, it ain't like 2001. I used to have clients that would call me asking for a stock quote. That's how old I am. Michael, how much is Pfizer? I mean, nowadays I can look it up on my phone, see the chart, see what their earnings are, see who just bought shares, all while I'm eating a sandwich. Okay. So that's how far we've come. Things change much faster than every 6 months, but the time of only meeting with somebody once a year, it's behind us. In my opinion, things change way too fast. So let's make sure you're rebalancing, or maybe you did buy gold and it was 2,000 and now it's 4,000. You need to rebalance that, take some profits and put it in. You need an advisor, in my opinion, that's going to be more of a financial coach. What are we budgeting for? What is our vacation plans this year? Do we have any big expenditures? Have we factored in what Social Security will be? Are we going to have to, are we taking too much money out of our IRAs? Because now we have IRMA that we have to think about with Medicare, and now we have to spend more premiums on Medicare. That is what you should be looking in with your CPAs and your financial advisor. You need somebody that not only helps you with volatility, but is more of a financial coach. Are they coaching me through when I take distributions and how taxable they are, or how much they're going to affect my accounts by going up or down? What scenarios can you give me, Mike, if the market was down 10%? What would I look like? That's what I stress. That's where the human element will never be replaced by a computer. Those are questions that you should be having. Volatility is always going to be a part of the market. Trust me, I've had guys that are literally rocket science for Lockheed Martin that are still clients, and they still ask me, Mike, I've done all this research. How come the market's not going up? Because if it was that easy to figure out, it would have been done way before us. The market has way too much emotion in it still to this day. And you cannot predict emotion, unfortunately. So, as my wife will tell you. So, have a wonderful rest of your day. I hope this podcast helped. This is one of our shorter ones, but I really wanted to just touch upon volatility. It's going to come. Make sure you're set up for handling volatility, not only emotionally, but what it would happen if it happened in your account, because it doesn't always go up and it doesn't always go down. This is Mike Hill, Money Matters, right here in Midlothian, Texas with Hill Financial Group. Like, share, all the things that you can do on social media. We are lucky and blessed to be able to bring this to our clients and all those around us. Take care.